Welcome to the latest edition of Market Signals Podcast, everyone. My name is Mark Zabicki, Chief Investment Officer of LPL Financial. Joining me today is our esteemed fixed income strategist, Lawrence Gillum. Fresh off maybe a week off between Christmas and New Year's. Was it, Lawrence, a full week off? How are you?
I'm doing great, Mark. I did have a week off. I appreciate that. It was nice to decompress, get away for markets. Although I did have my Bloomberg terminal on the entire time, so I didn't take a complete step away, but it was good to kind of decompress a little bit. Happy New Year, by the way.
Oh, happy New Year. Happy New Year, everyone here. As we kick this Market Signals podcast off in the new series for 2023, this is Tuesday, January 3rd. And indeed, Happy New Year to you, Lawrence, and everyone within LPL Research, and also the entire audience out there. Thanks for joining us again. What we hope to accomplish is really talk a little bit, later, a couple of slides later, and talk a little bit about the Federal Reserve and what their plans may be for 2023 and how that may impact, markets as we begin to look out the early months and the early FOMC meetings for the early part of this year. But last week's key drivers, in reality, not a whole lot happened last week. Trading volume was light across the board, whether it's the bond market or the equity market. So there's not a whole lot you can take away from what happened in the market last week. House prices have continued to decelerate, down month over month by, 0.5%, down, still up year over year, but in a decelerating fashion. The CoreLogic 20-city house price index was up 8.64% year over year, but down from the prior month when there was up 10%, and change. Pending home sales were down 4% month over month and a big 39%, year over year. So the housing market clearly has slowed. Again, thank the Federal Reserve policy for that. Just thank a hot housing market that was bound to cool for that as well. Manufacturing activity last week was weaker. Initial jobless claims continue to be relatively stable at 225K. And as we mentioned, trading volume was low across capital markets last week. Again, not a whole lot to take away from what happened last week, given the volume. The U.S. equity market was, you can call it, relatively flat during the course of last week. Still some relative strength in European equity markets. Perhaps people are continuing to price in a little bit of an eventual, kind of an inflation deceleration at some point during the course of early part of next year in Europe, so that Europe continues to get a relative bid. Some general positive elements are continuing to happen outside of the U.S. and equity markets as well. We still we're still favoring U.S. equity markets. We think that's the right place to be. We're not completely convinced that a definitive recovery in non-U.S. markets is going to be sustainable. We'll see how that develops over the course of the next couple months into the new year. Turning to you, Lawrence, on the bond market, not a whole lot to write home about in 2022, and kind of a light volume last week. So how do you parse things now?
Yeah, for sure. It was maybe a fitting end to the year last week as bond markets ended negative, just how they started the year negative. And 2022 is going to end up being the worst year by far for core bonds. Core bonds, as measured by the aggregate bond index, there down 13% for this year. So it's not a good year for sure. But we do think with these negative returns, higher yields, we do think the opportunity set for fixed income has improved. But as it relates to last week, we probably saw some window dressing given the negative returns that we've experienced throughout 2022. Maybe some portfolio managers out there want to reduce their exposure to fixed income, maybe have an easier conversation with clients, reducing that fixed income allocation. And we're seeing yields today move lower. So maybe there was a technical bid out there on over the past week, but certainly that's reversed this week. But certainly not a good week, month, year, or frankly anything for 2022 for fixed income markets.
Yeah, and commodity markets last week, not a whole lot to write home about here either. Relatively, mixed. Energy was under some semblance of pressure. Oil prices have been under a bit of pressure over the last several months or so. If we look at the economic calendar for this week, the data is really going to be driven by the FOMC minutes, which come out tomorrow, ADP employment survey, and also the overall non-farm payrolls and U.S. jobs report, which will come out on Friday. Here, the Federal Reserve is going to be looking for continued weakness in jobs, and we'll get to that in a minute. But on a non-U.S. basis and economic data, some import price numbers from Germany, producer prices from the Eurozone, and also CPI from the Eurozone as well are probably some of the key things to watch out for. Manufacturing activity continues to be relatively weak in Germany and the Eurozone, which is not necessarily surprising. We get another manufacturing orders number out of Germany later on in that week. As we look ahead to key issues this week, we mentioned the FOMC meeting minutes for the December 14th meeting due out Wednesday, which is tomorrow as we record this. Lawrence, again, turning to you on the FOMC as we dissect what the Federal Reserve is likely going to give us in the early months of this year. What do you think the meeting minutes are going to say?
Yeah, for sure. So in December, the Federal Reserve released their updated summary of economic projections. This is where they provide their expectations for economic growth, inflation, interest rates, et cetera. So there's likely to be some conversation around those numbers. We've talked about this internally. Maybe some of these numbers that they've released, some of these economic numbers that they've released, may not really conform to reality. So we'll have to see some of those discussions that have taken place within the committee. What kind of disagreements they've had within the committee as it relates to the terminal rate for the Fed funds rate, where inflation is headed over the course of 2023, the labor market, how hot is that going to be in 2023? So there should be shouldn't be any surprises. I'll say that, but there should be some decent information that comes out tomorrow with the release of these meeting minutes.
So do you imagine there'll be, call it, further indications that the Fed is likely going to pause or pivot here, or they're going to bring their interest rate increases to an end in the early part of this year? Is that fair to say?
Yeah, well, I think that's a fantastic point, because if you think about some of the conversations that the Fed officials were having leading up to that December meeting, there was really a bifurcation between Fed officials of doing too much and doing too little in terms of rate hikes. So we'll see if any of that is parsed out as well. But frankly, it really comes down to Chairman Powell, Lael Brainerd, and the Fed president of the New York Fed. Those are the three important ones. So they can have all these discussions, but really it's up to what those three think primarily to see how they're thinking about monetary policy. But we did see a lot of agreement as it relates to interest rate hikes in 2023. If you looked at the dot plot, there was I think 15 to 17 that were above 5% or close to 5%. So there was a lot of agreement in that dot plot report, but that maybe there's some additional conversation that goes into those dot plot expectations, because coming into that meeting, there were some disagreements.
Yeah. And when we look at the non-farm payrolls number on Friday and the employment rate of 3.7%, we're getting some deceleration in terms of the strength in the U.S. jobs market. Is that enough? I mean, do you think that we're going to get or going to need to see, in terms, if we were Federal Reserve members, we're going to need to see more weakness in the jobs market for the Fed to actually pivot in early 2023?
That's what they've told us. The job market has remained almost stubbornly strong. So the Fed has said that they want to see some cooling in the job market. If the jobs number comes in at or maybe even below expectations, we have that $200,000 job growth number there on the screen. If it comes in around that number or maybe even slightly below that number, we could see a rally in risk assets, because that could indicate that maybe the Fed is going to pause or is going to be able to take their foot off the brake over the course of 2023.
Yeah, and as we set the stage for Fed policy, or at least the current outlook for Fed interest rate policy in the early stages of 2023, we take a look here at the Fed funds futures market, and we spotlighted this today, again, Tuesday, the January 3rd, as of 9:30 a.m. that morning, Eastern time. It looked to us that the markets were pricing in a rate hike in February, on the February 1st meeting and the March 22nd meeting. And then that may be it for a while in terms of Fed policy into the back half of the year, where markets are actually pricing in a rate cut in November and December, and another one in January 2024. Is that in accordance with the way we think about it, Lawrence, in our asset allocation meetings, and how do you think the market's going to digest this if this does come to pass?
Yeah, for sure. That is consistent with how we're thinking about markets. I mean, if you take a step back, the Federal Reserve has been such an important story throughout 2022, such a headwind for risk assets, for bond markets. So coming into 2023, we still think the Fed's going to be a story, just not as big a story as it was last year, because of the fact that they've done so much already. If you think about what the Fed has already done, it's already been one of the most aggressive rate hiking campaigns since the 80s. The Fed started with the Fed funds rate close to zero. It's at 4.5% now. So markets, we think are rightly pricing in a slowdown in these rate hikes over the course of these next two meetings. We think 25 basis points in February is probably appropriate. March is still a wild card. They could go 25. They could pause at that point. We've been told Milton Friedman told us this a long time ago that these rate hikes act with a long and variable lag. We haven't seen the impact of these rate hikes through the real economy yet. Housing market, yes, that's certainly been or is one of the most interest rate sensitive parts of the economy. But the rest of the economy, you could argue, hasn't really felt these higher interest rates. So the Fed, we think, doesn't want to overdo it and unnecessarily cause a deep recession if they don't have to. So maybe 50 basis points more this year, and then pause throughout the summer months into the back half of the year. And then we think that we'll see how they go from there, maybe even a cut or two.
Yeah, and I'll take the equity side of the coin here, and I'll leave you with the fixed income side. I mean, we've talked in our asset allocation committee meetings about the Fed certainly being a headwind definitively in 2022 for risky asset prices, and we think, at least from a sentiment perspective, the pause and eventual reversal in some of the Fed rate hikes, perhaps in the latter half or the latter portion of this year, could actually be a sentiment tailwind of at least it's going to be less bad, if you will, for 2023, and that may be beneficial for equity prices, and that's how we think. That's why we call ourselves cautiously constructive on the equity market for 2023. Probably going to get gains as we see it in our S&P 500 target for this year. So that's the equity backdrop. Lawrence, what is the expectation for fixed income?
Yeah, for sure. The bond market has priced in a softening tone for the Federal Reserve over the course of 2023. So if the Fed does follow this market implied rate hiking campaign that we're showing on the screen, we could see risk asset, high yield assets, plus sector assets rally because of the less of a headwind, as you mentioned, for those types of securities as well. In the Treasury market, I think that there's a lot of these rate hikes already priced in, certainly in the front end of yield curves. So if there is a pause or even cuts coming, we could see the front end of the rally, front of the yield curve rally, the curve steepen, et cetera. So the headwind that was prevalent last year because of the Federal Reserve is, we think, just going to be a tailwind or less of a headwind for all asset classes over the course of this year. A couple comments real quick just on the Federal Reserve, just the composition of the Federal Reserve. We don't talk about this a lot, but every calendar year they rotate committee members in and off the committee. So this year is no different. And they're rotating in on a net basis. So when you look at the committee members that are coming off the committee and then those ones that are coming onto the committee, net, we are going to see a more dovish makeup of the committee. So fewer individuals on the committee that are overly aggressive, that want to continue to hike rates. So we could see some softening in the language throughout 2023, just because of the makeup of the committee is going to change.
Yeah, I mean that is a great point, and I people like to say that the Federal Reserve is not necessarily is an independent body, and it may or may not be, but I mean certainly the influence of given members on the board is material to how the Federal Reserve moves through its interest rate decisions. So just kind of stepping back, maybe Lawrence, taking fixed income out of it, taking equity out of it for a moment, and we're all investors here. So if I'm contrasting 2023 relative to 2022, am I feeling pretty good? Am I feeling kind of? I mean, am I not? What would you say to that?
Yeah, no, we think the worst is behind us in most markets, certainly equity market and the fixed income markets as it relates to these interest rate pressures. The bond market, as we just talked about, worst year ever for fixed income, for core fixed income, because of one of the most aggressive rate hiking campaigns ever, or at least since the early 80s. So with that behind us, bond market's not going to have as much interest rate pressures on these securities. So that should allow, dare I say, the boring bond market to come back to life, because last year was anything but boring. We do think that over the course of these next 12 months, I'll take a boring bond market any day of the year, but we do think that this 2023 is going to be more of that boring bond market that we've experienced pre-2022.
Yeah, and as we've talked about in this forum before, it's for those income-oriented investors, now may be a unique and important time to take down some fixed income exposure. Is one thing that we would be looking to do in 2023. In our strategic and tactical asset allocation committee, we certainly watch this stuff on a weekly basis, and we are forecasting a little bit of a better year in 2023 based on a little bit more of a tailwind from the Federal Reserve in terms of how investors should think about their exposures. That should benefit bond prices. It should benefit equity prices, as well. The 60-40 portfolio is not dead, so we would take that home as well. So with that in mind, Lawrence, we'll bring this Market Signals podcast to a close. The first one for 2023. I want to thank you for joining me today, and I'm sure we'll see you out throughout the balance of 2023 in this forum multiple times. And I want to also thank the audience for joining us as well, not only for this issue, but also future editions of the Market Signals podcast. We hope to bring you some good stuff weekly. Happy New Year, and thanks for joining.